Hello, fellow Rebel Capitalists. Hope you're well. So we got big news in the housing market. Some states, some cities are starting to see a decline. Does this mean that we're going into the next GFC? Probably not. Probably not. But what does this mean for the overall economy? And we have to recognize that some of the data we are seeing right now in the housing market looks eerily similar to 2007. We're going to be going over the details here in just a moment. Before we do, I want to remind everyone the big news of the day is Rebel Capitalist Live coming up here in about 1 month. I'm starting to get better at doing the pitches here. Josh reminds me every video before we start here. We got Barnes, McIntosh, Brent Johnson, Kiyosaki in there in the flesh, Joseph Wang, Snyder, Rick Rule, Maloney, Hartman, and we're going to be naming a couple more pretty soon. So you guys aren't going to want to miss out on this. You can get your tickets at rebelcapitalistlive.com. All right, now let's get back to the action, Josh, and go over where do we want to start? Well, let's start with a video or a podcast I listened to this morning. And it's from Thoughtful Money, my good buddy Adam Taggart over there. I would highly recommend watching this video. Very, very good with Nick Jurley. And he goes over this, all the data he has from this ReVenture app, which it looks pretty neat. But what he started talking about is how we are starting to see some nominal declines in markets. And in some cities, we're seeing big nominal declines like Austin. And he's actually projecting that we're seeing, or we might see some nominal declines throughout some of these states that have been very, very hot. States like Florida, states like Texas, Arizona, Colorado, and then, of course, District of Columbia. Who would have thunk the rates or the prices are coming down there with Doge and everything? But what Nick does is these forecasts aren't just, oh, well, the macro stuff is doing this. He actually looks at the specific housing market data. He kind of ignores the macro. And he bases a lot of the conclusions or the predictions on price to income. And for me, this has always made a lot of sense. It's not just the fact that home prices are way higher than they were adjusted for inflation in 2006. Everybody knows that. But even more importantly, what are they doing relative to incomes? Because at the end of the day, the affordability is really about income and interest rate. And if interest rates kind of mean revert, which we usually see there in the mortgage market, then you've got one other variable, and that's incomes. And if incomes aren't going up at a certain point, there's not enough income to keep the housing market floating. So the housing market has to come back down to a certain degree to match up with those incomes. The problem here is the U.S. economy is so predicated that the U.S. economy is asset prices. They're basically one and the same right now. And like I was telling Chris earlier in our previous video, this is fantastic on the way up, where everyone can get rich and you don't have to work. You don't have to work any harder. You don't have to produce more stuff. You don't have to become more efficient. All you got to do is just buy an asset and you get rich and your purchasing power goes up. So this is fantastic on the way up. The problem here is as the asset prices go up in value, the economy becomes more and more dependent upon those asset prices because so much of the aggregate demand is coming from that phenomenon. It's not coming from working harder. It's not coming from producing more. So if we see a small decline when housing prices are way up here, that disproportionately impacts the economy negatively. Whereas if prices were, let's just say, price to income ratios were where they were in 2012, if we have a 5% decline in housing prices, it's like, okay, whatever. It's a 5% nominal decline. We'll make it through to the other side. that really wouldn't be a big deal if housing prices were quote unquote normal relative to incomes. But now that they're so far stretched, that 5% decline represents such a massive amount of purchasing power and net worth. Then all of a sudden, it's something where we could get this feedback loop where it impacts the economy far more than it otherwise would. And this increases the unemployment rate, makes it harder for people to pay their mortgage, more selling, more inventory, more supply. Housing goes down as demand is declining. Even if interest rates are going down, it doesn't matter how low the interest rate is. If you're losing your job, you're not going to be able to buy that house, or you might have to put your house up for sale, especially if maintenance costs are going up, insurance costs are going up, taxes are going up. You guys know kind of the bind that people may find themselves in. So this is kind of the lens that I don't want to look at this video through the lens of, okay, the housing market is going to go down by 50% like it did during the GFC. I don't want to do that. I want to say, well, what if the housing market just goes down by 5%? That's it. Let's just think through what the outcome would be for the overall economy, and then how that would reverberate back to the housing market itself. Okay. So starting off here, let's, Josh, can you see this?
Yes, we can see it, but I don't think we'd be able to hear it.
No. I'm not going to do the audio here.
Okay.
I just want to show that based on Nick's app, which again is mostly the input. There's a few inputs that go into this forecast, but the main input is price to income. And for me, that makes a lot of sense. Makes a lot of sense. So the forecasted price growth for DC, thanks to Doge, but that's not one of his inputs, by the way. His input is not Doge. His input is simply, or for this, what I know he explained it, which is why you got to watch the video. It's supply versus historical averages, and it's price to income. Those are the two main components. So if you see the price to income stretched, and if the supply, let's say, homes for sale on the market are 2,500, when usually they're around 600, okay, that's, you don't need to be a rocket scientist to determine that that will likely lead to prices going down. So I know he's got a few other variables there, but those are the two main components if I remember the podcast correctly. So negative 5.8%. Now, this is the forecasted price growth here. And then Florida, you've got negative 4.9%. Texas, negative 4. Arizona, negative 4. Colorado, negative 4. Utah, negative 3.5. Now, to be clear, and we go all the way down here where we stop the negatives at Oklahoma. Now, to be clear, there are some markets that he went over where his projected price growth is not just positive, but it's actually very, very good. I forgot, oddly enough, it was in the Rust Belt, I believe, like Ohio, kind of Midwest. There they are very, very short supply. And the price to incomes are much more reasonable. And so he is expecting the opposite. He's expecting positive price growth as opposed to negative. But what we're trying to do here is determine, okay, if we do have negative growth, which we are starting to see, negative prices, in other words, in nominal terms, throughout a lot of these markets going into 2026, let's say for the next year, and prices even go down by 2%. That doesn't sound like a big deal, but you're basing that on the economy the way it was. You're not basing that on how the economy is today. Let me show you what I'm referring to. Let's go over to Twitter, and I want to show you my Twitter feed. Look at this. This is a stat I pulled up this morning. This is according to Redfin. The combined value of U.S. homes gained 2.5 trillion in 2024. Sounds pretty good, right? That's increasing people's net worth. That's increasing people's purchasing power for sure. But that means that the market cap, if you will, of the U.S. housing market is now at $50 trillion, 49.7, $50 trillion. Think about how much demand that has created. And let's just say it's gone up by $20 trillion, which it probably has just since the cerveza sickness. Think about that. Think about the aggregate demand there. And just realize that if we just go down by 2%, 2% over the next year, that wipes out $1 trillion worth of purchasing power. Gone. It's Fugazis. Because those are just paper gains. And if we have a 5% decline, okay, now we're talking real numbers. 2.5 trillion in net worth and purchasing power. Fugazis, gone. So again, we don't need to see like a 50% decline like we saw from 2006 to 2012 to have a serious impact on the real economy because of this perversion that we've seen in the real economy, especially since the cerveza sickness, where it's just really about one thing and one thing only. Its number has to go up. Our whole economy is based on fart coin. Number go up. And if number doesn't go up, we got big problems. We got way bigger problems than we would have had in the 80s, in the 90s, I would argue maybe in the early 2000s, way bigger problem than we would have in 2012 for sure. So now let's go over to some of these metrics that Nick uses for his app, which make a lot of sense to me. I've always kind of focused on this price to income ratio, I think for obvious reasons. So if we look at this long-term trend chart, we see the home price versus incomes in the United States. So US median annual income. Unfortunately, this red line is the home price. The blue line is income. So I don't care how much of a housing bull you are. And if you have that opinion, that's fine. I'm sure you've got some legitimate arguments. But no matter if you're a bear bolt and, agnostic, you look at this chart and you realize that spread between the red line and the blue line, that dog don't hunt. Like, you want to talk about the debt being unsustainable. I'll tell you what's unsustainable. This. That is unsustainable. So you got one of two things that can happen. Either the red line has to come down a little bit, or the blue line's got to go way up. So based on all the other economic indicators that we talk about on this channel, and understanding that there are no certainties, only probabilities, what do you think is the highest probable outcome? Red line go down or blue line go up? For me, it's probably red line going down. And again, this is, if the red line goes down, it's not like the market is just well, it would. I mean, the market would be quote unquote crashing, I guess. But even if it goes down slowly, just 2% per year, that's what needs to happen here in order for that blue line to slowly, gradually catch up, right? We could see that. Again, it doesn't happen overnight. Like Nick and Adam point out, the housing market's not like the stock market. It goes down in 20% in 2 weeks. Not going to happen. It's just this slow, gradual decline of 2%, 2%, 2%. And then you hopefully get the incomes going up to a point where they once again meet and they're back to where they should be. And if we go way back on this chart, it's exactly what you would expect. This is not the norm. Look, here's 2006. Look at the delta here, right? The delta is less than it is today, back in 2006, as far as the price to income. So this, when you get this type of spread, it's the anomaly. It's the outlier. This is not the norm. The norm is when the red line is pretty much right on par or right on top of the blue line, which again would make a lot of sense. Home prices going up with incomes. Imagine that. So this is where I don't know how you look at this chart and how you're like, and how you come to the conclusion that, oh, this is not something we need to worry about. And, oh, there's no possibility that prices go down. Now, maybe they don't go down. Maybe they continue to go up. Maybe Trump comes, I mean, they sure as hell have been able to financially engineer it in Australia. And they've been able to do the same thing to a certain degree in Canada, where the government just comes out with program after program after program, which is basically not making housing affordable by bringing prices down, but by making housing more affordable by just financial engineering and somehow making the payment more affordable by no money down or the government giving you $100,000 or whatever it is. It just keeps the market going up and up and up. We could absolutely have that 100%. I mean, who knows? Next recession, we get a UBI. I mean, I guess it's definitely a possibility. You know, what next recession, I mean, it works so well. And this is, looking at through the lens of the government. Well, the mortgage, what was that program even called? I can't remember, where no one had to pay their mortgage, no one had to pay their rent. Whatever it was called, the forbearance, I think it was. This program works so well during the cerveza sickness. Nobody got hurt. Then let's just ban foreclosures for the next 2 years. Why not? And it's not like Trump would be opposed to this, right? That this is, no matter how much you love Trump, you have to admit he's very keen on intervention, just so long as it's his intervention. So, if he thought it was a good idea to go ahead and ban foreclosures, I definitely think he would consider it, because he doesn't have that principled position. He doesn't have that philosophical core like a Ron Paul would, where he'd be like, no, that's not a good idea because I've studied Austrian economics. So that's definitely on the table for sure. But outside of government intervention, we go back to the reality of the situation where red line needs to go back to blue line. At some point, this is going to mean revert. It's just, how does it mean revert? And what are the probabilities around that? And then we go back to this idea that the economy is so dependent on these asset prices, and just a slight move means trillions of dollars wiped off the balance sheet, the net worth of Americans. That's what is so unique about today. We've gotten a get out of jail free card here. We've gotten a free ride. We've effectively gotten UBI for rich people, whereas they don't have to. You could have just owned a few assets since the cerveza sickness, and you could have not even worked, let alone work more. You could have produced less, yet your purchasing power would have skyrocketed just because you own assets, right? That's that's not sustainable. At some point in time, that the rubber meets the road there. And like I said, it's great going up, but as soon as you get that first tick down, that's where you get even more trouble than you otherwise would have, because you're basically living off the dole. Whereas back in 2012, much more of that overall purchasing power and aggregate demand from the United States economy would have come from actually work and from producing stuff and productivity, efficiency, etc. Now let's go over to this chart, which kind of combines the monthly cost of a mortgage. So you can see it in terms of just your monthly payment. So we've got real monthly principal and interest price. So I believe this is your monthly payment adjusted for inflation, as far as I can tell. And this similar story to what we see at the price to income, where back in, what happened? Why did it do this? It refreshed on me. Hold on a second here. Let me see if I can go back. It gets a little confusing when we see all these. So I just try to give the United States just so we get a proxy here. Okay, good. We're back to this. So we're at an all-time high, bottom line. We're at an all-time high. And this is the affordability of the monthly payments. So this is why demand is pretty much at an all-time low. So now it's all about the supply side of the equation. So if we go into recession, this is going to force people to sell. Now, the good news is they've got probably a ton of equity, unless they bought over the last 2 years. So that could bail them out, but that goes only so far, because since demand is so incredibly low right now, a little bit of supply coming online in addition, that's going to make those prices go down. Not by 50%, by 2%, 3%. And if we see that for a few years and incomes aren't going up, that's where you get just a massive hit on aggregate demand that really moves the needle. And if we haven't gone into a recession, that could be a catalyst. And the problem here, of course, is if you do get an economic downturn because of all the other things we talk about on this channel, that's going to exacerbate the problem of supply. And then you get into that feedback loop. So the main data points that I'm seeing that are similar to 2007, not that this means we're going to have a 2007 GFC crash or anything like that, but it's all about that price to income, And it doesn't matter if you're a bull or a bear, you have to consider that in your economic analysis as far as what you think is going to happen. And keep in mind, this is different from state to state, and it's different city to city. But like 2007, in fact, just let me give you guys a quick, let's go back to the all. And here is 2007, 2006, when we got to that peak. Now, look at my point here. I don't know if you guys can see this, but housing prices didn't come down all at the same rate and all at the same time. It was different. You had some markets that came down before others. Other markets came down a lot more than others. And the timing, it wasn't the exact same day, right? It was spread out throughout, let's just say, a year or so. And even before we got to the big crash, you saw some markets that rebounded and started going up. I think that's around like San Francisco as an example. And look at this one, Portland. So it peaked out. Well, the first peak was in July of 2026. Then it goes down. But then it goes right back up to a higher level in 2007. And then we get the Wile E. Coyote. So the fact that all housing markets aren't coming down right now, let's just say 20% are, it doesn't necessarily mean that they're all not going to come down. And it doesn't necessarily mean that they all are going to come down. But it's just like interest rates going up during the 2008 GFC. We know that can happen during a recession. So just because rates are going up doesn't mean that we're not having a recession. You see, so looking at through the lens of housing, just because only 20% of the housing markets are going down or projected to go down, it doesn't mean that we won't go into a scenario where the entire national market is coming down, but to lesser and greater degrees based on the specific geographic location. And look, you could have 90% of the markets coming down while 10% are going up because of supply demand dynamics, people moving. You know, he was talking about how some of the markets he's more positive on right now are the markets in the Rust Belt. And it really got me thinking. I'm like, I wonder if during the cerveza sickness, everyone moves to a red state because they're like, forget it. I don't want to do the masks. I don't want to do the lockdowns. And I can, move from California, and my purchasing power goes a lot further in Tampa, as an example. So everyone moves there. And then what does that do? That drives up the prices. So then all the builders go down there and they start building and building and building and potentially overbuilding. But prices continue to go up and up and up to the point where these markets are now no longer affordable. They're like California was. And so then you have the people in these markets, like Florida, that are just middle class, and they're trying to, I'm priced out of a home here. There's no way I'm ever going to buy a home. So maybe, I don't know. I got an uncle in Ohio. I can get a house out there for 250 grand, and I can work remotely. So it's just an idea. I don't know if this is what's happening, but it's just interesting that in the Rust Belt, we're starting to see the home appreciation, because these just happen to be the states where the housing costs in nominal terms are the are the absolute lowest. And you could just see this migration blue to red, and now you're seeing a migration from red to cheap. Something we got to watch out for. Okay, guys, enjoy the rest of your afternoon. As always, make sure you are standing up for freedom, liberty, free market capitalism. Make sure you're getting your tickets to Rebel Capitalist Live. This is something you do not want to miss. You can get them at rebelcapitalistlive.com. You can see past speakers, give you a little promo reel. You can see current speakers who you can expect to meet, shake hands with, have a beer with, ask them a question. That's what's neat about Rebel Capitalist Live is you can hang out with these people. They're not removed from the crowd. The speakers are all integrated. And the best part, of course, is meeting your fellow rebel capitalists. So on that note, Josh, do you want to do a little Q&A here on Rumble?
Yep, let's do it.
Okay, cool. So for those of you on Twitter and on YouTube, if you want to ask a question, real estate market, whatever, econ, I know markets are closed today, so there's not that much action. Dollar, bonds, any of that stuff, just shoot over to Rumble. And Josh, can you put a link up there for the folks? There you go. You can just click that link and that goes right over to the live stream. And just if you do have a question, start with the word question. I can see it and then hopefully answer it to the best of my ability. All right, guys, I will see you on the next video, or I'll see you over here at Rumble.